When we talk about the Florida housing crisis, the media always blames the weather. They show you clips of hurricanes, rising sea levels, and coastal erosion. They want you to believe this is a climate issue. But behind closed doors in Manhattan, the world's most powerful financial institutions are running a very different calculation. Wall Street is quietly executing a silent attack on Florida homeowners, and it has absolutely nothing to do with saving the environment. It is a multi-billion-dollar corporate strategy designed to drive regular families into bankruptcy, freeze the housing market, and systematically wipe out middle-class home equity. They are pulling the financial plug on entire zip codes, turning valuable family assets into uninsurable traps. And this is where things get ugly. Imagine sitting in your living room in Miami or Fort Myers, believing your property is a secure investment for your retirement. But on the trading floors of Wall Street, institutional investors have effectively taken a short position against your neighborhood. They aren't betting on your home burning down or flooding, they are betting on making your home impossible to maintain. In 2026, the hidden cost of holding property in Florida has reached a breaking point, driven by artificial financial inflation. The public headlines are constantly screaming about billionaires moving their companies to the Sunshine State, creating the illusion of an endless real estate boom. But on the ground, the reality is that the financial floor is being cut out from underneath the people who actually built these communities. Of course, not every single neighborhood is facing this immediate threat, and deep inland sectors are managing to stay under the radar for now. But for the vital suburban core along the coasts, Wall Street's invisible hand is squeezing tight. To understand the mechanics of this attack, you have to look at a hidden financial market that most ordinary Americans don't even know exists: reinsurance. Local insurance companies in Florida don't actually hold the risk for your home. They buy insurance for themselves from massive global financial syndicates based in New York, London, and Zurich. In 2026, Wall Street investment funds heavily restricted the capital flowing into these reinsurance syndicates, driving up their rates by 35% for the Florida market. This was a calculated corporate squeeze. It forced smaller, local insurance companies into immediate insolvency, or left them with no choice but to pass those catastrophic costs directly to you. The media narrative frames this as a natural response to regional risks, but the reality on the ground is a deliberate restructuring of capital to exit the middle-class market and protect corporate balance sheets. Do you believe it is ethical for institutional investment funds to manipulate the baseline safety of American communities just to satisfy quarterly earnings reports? Naturally, from a purely capitalistic perspective, investment managers are legally obligated to maximize returns and minimize exposure for their shareholders. But this calculated retreat has unlocked a secondary weapon within the banking system. This is where the trap snaps shut on the average family. Many homeowners believe that if insurance premiums become too expensive, they can simply drop their coverage and take the risk. But Wall Street owns the banks, and the banks own your mortgage. Over 60% of residential properties in Florida are tied to a standard 30-year bank loan, and the fine print of those contracts states that going uninsured is a material breach of contract. The moment your private insurance provider abandons your policy, the bank's automated compliance system triggers a forced intervention. They will apply what is known as force-placed insurance to your account. This isn't a normal policy. It is an internal bank product that costs up to 4 times more than a standard premium, covers absolutely none of your personal property, and is billed directly to your monthly mortgage statement. If your income cannot absorb an unexpected $2,000 increase in your monthly housing payment, the bank will declare a default and initiate foreclosure. The public narrative always promoted a mortgage as the safest path to generational stability, but in this managed crisis, it is a legal trap designed to repossess your asset. What option would your family have if your mortgage provider demanded an extra $24,000 a year just to keep your home legal? To be fair, high net worth individuals who purchase their real estate entirely with cash are completely insulated from this banking leverage. But for the working class, this mortgage pressure is driving them straight into a calculated corporate land grab. When an independent middle-class family is broken by these rising fixed costs and forced to list their home at a massive discount, who do you think is buying it? It isn't another young family trying to buy their first home. It is private equity sharks like Blackstone, Vanguard, and multi-billion-dollar corporate landlords. Data from the first half of 2026 reveals that institutional cash buyers are snatching up distressed, underinsured residential properties in Florida at an unprecedented rate. They don't care about the high cost of insurance because they self-insure their portfolios with billions in corporate cash, bypassing the banking system entirely. The mainstream headlines spin this as institutional investors stabilizing a volatile housing market. But the reality on the ground is far more sinister. They are systematically destroying middle-class homeownership to turn America into a permanent renter nation. Do you want to live in a future where your children can never own property and are forced to pay permanent rent to a Wall Street algorithm? Granted, state-backed housing finance authorities are trying to launch subsidy programs to help local buyers stay competitive. However, the raw scale of institutional capital moving into the market is completely overwhelming these local defenses, and it's hitting the condo sector the hardest. Many retirees thought they could escape this entire crisis by downsizing into a beautiful oceanfront condo, believing the building association would absorb the economic shocks. But Wall Street found a way inside the building through the HOA board. Private equity funds have been quietly purchasing blocks of units in older Florida condo buildings. Once they secure enough leverage, they use structural safety laws to enforce massive, immediate special assessments on the remaining residents. In 2026, elderly condo owners on fixed retirement incomes are receiving surprise assessments ranging from $30,000 to $80,000 per unit to fund building insurance and structural reserves. The public narrative claims these mandates are strictly about preserving human life after recent structural failures. But the reality is that these sudden, unpayable bills are being used as a legal weapon to clean out middle-class seniors and force them to sell their units to developers for pennies on the dollar. If your building association demanded $50,000 cash within 90 days, would you be able to pay it, or would you be forced to hand over your keys? Of course, newer luxury developments with wealthy corporate reserves are handling these safety mandates smoothly without placing a burden on their owners. But for the standard middle-class complex built 20 or 30 years ago, this is a financial death sentence. This process leads directly to what economists call a liquidity evacuation. Your property might be valued at $600,000 on paper, but in reality, it is a frozen asset. When you try to sell your home to escape the rising fees, you hit a wall. Traditional buyers need a bank loan, and banks require active property insurance before they release the capital. If your neighborhood has been blacklisted by the reinsurance algorithms, the bank blocks the transaction. The real estate brochures still show rising median home prices, but the reality on the ground is that everyday transactions are completely paralyzed because the property cannot be financed. Your life savings are effectively trapped in a structure you cannot afford to keep and are legally prevented from selling to an ordinary buyer. If a property was blocked from traditional financing, would you take the risk of buying it using your own hard cash in today's market? Obviously, international investment pools are happy to buy up these frozen assets, knowing they can hold the land for the next 50 years. But for a regular family whose entire net worth is tied up in home equity, this liquidity trap is a devastating wipeout of everything they've earned. If you think this silent attack is just a localized problem meant to punish the state of Florida, you are completely missing the macro picture. This is the blueprint for an unaffordable America. The exact same financial mechanics are being deployed right now in the wildfire zones of California, the hail corridors of Texas, and the floodplains of Louisiana. Wall Street is changing the rules of the game, shifting the burden of risk entirely onto the middle class while converting residential real estate into a high-yielding corporate commodity. The policymakers keep telling us the national economy is fundamentally sound, but the underlying structure of homeownership is being altered. The financial security that allowed previous generations of Americans to build a stable life is being replaced by engineered volatility and permanent rental debt. Take a look at your own property insurance renewals and mortgage statements this week. Can you see the early signs of the squeeze appearing in your hometown? Let me know your thoughts and your local costs in the comments below. The United States has an incredibly resilient economy, and grassroots legal challenges may eventually force federal regulators to step in and limit institutional land acquisition. But before those protections are put in place, individual homeowners must recognize the trap before the system locks them in permanently. Subscribe to stay informed on these macroeconomic shifts, and we will see you in the next report.